Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, December 18, 2015. Stocks ended the week on a pretty clear sour note, and we'll look at the balance of evidence, and I think it still continues to favor the bears at this point of the game in the stock markets. Bonds held support, TLT held support, while the municipal bonds actually hit an all-time highs. Dollar also held support and I think rebounded within the bigger uptrend. While gold, oil, and natural gas are all under pressure, and we'll look at them as they continue to either make lower lows or trade sideways. All right, so this is S&P 500 SPY ETF. So this week we had several interesting patterns. First, we had actually this was last week, we had I think was a first support break with a close below the November lows here on Friday. Then Monday, we had a pretty powerful rebound here, with a hammer candlestick, and next day we had a gap up and continuation higher. Then on Wednesday, this looked like a very nice potential continuation higher, and the bulls really want to see this powerful rebound with a continuation. But Thursday was just a bad day. We had a gap up, from the close here to here, and then just non-stop selling throughout the day. Basically the day ended on the lows. And then Friday we had a gap down and a continuation lower throughout the day. So right now we have a three-day pattern, which is this hollow candlestick on Wednesday, followed by a bearish engulfing pattern on Wednesday, Thursday, and then Friday a confirmation. So for now we have a confirmation of a bearish engulfing pattern or outside reversal pattern. And this certainly does not look good, but I think possibly short term, very short term, we're a little bit oversold, so I think we may see a kind of like a bounce back and attempt to recapture these highs. But generally speaking, I think that the stock market is bearish, so I am looking for bearish setups and shorting opportunities. Again, I was pointing out this on balance volume, which has been trending lower, even though we kind of, relative to this high was higher, but this just the patterns on balance volume kind of continue to trend lower, and this is not what you want to see. You want to see a volume expanding and on balance volume pushing higher. While the exact opposite is happening. Like I said, for example, this is a breast momentum oscillator. You can see it's a little bit on the oversold side. However, if we're going to say that S&P 500 is currently a bearish security, then oversold conditions should be completely ignored, and overbought conditions should be shorted. Now, we'll see how it plays out, but possibly there may be a small rebound maybe to this 206, 207 area next week. All right, let's now look at the New York Stock Exchange Composite Index. So this is a chart of a New York Stock Exchange Composite Index on a daily charts. So this is I think a weaker chart than the S&P 500 because you can see we're making a series of lower lows and lower highs. So basically we had several support breaks. We had a major support break as was with S&P 500, but the S&P 500 actually came up to almost all-time highs, while the NYSE really didn't really make it that high. On this chart, I wanted to point out the advanced decline line. I've pointed this out before. You can see that it's trending lower. Advanced decline volume line also trending lower. You can see the percentage of stocks above the 200-day exponential moving average is currently at 29%. So only 30% of the stocks within the index are trading above this green line, the 200-day moving average. This is a very small amount, and I think that this such a small reading is really incompatible with a bull market. Same with bullish percent index. We see that we had a drop below the 40%, and we are yet to recover above the 60% mark, and currently we're at 43. So also one more very useful indicator, I think, is this percentage of New York Stock Exchange Composite new highs less new lows divided by total active symbols. So here you can see that we dropped below 5% here in July, but we have not since then recovered above the plus 5%. So we really continued, making more and more stocks within the index are making lower, 52-week high, 52-week lows. So this again doesn't bode well for the general market. And right, so once again, as before, we had a support break here, and possibly again we're a little bit on the oversold side, but I think that the rebound, if it does materialize, maybe it will go to like here or possibly even to here. I think the bears will step in at that point and try to push the prices lower again. So another piece in the puzzle of the stock market is, of course, trend determination. So here we see a S&P 500 on a daily time frame going back to 1970s with the price actually removed and the moving average, 50-day moving average and the 200-day moving average present. So if we are going to say that 50-day moving average is above the 200-day moving average, we're going to keep a bullish bias, and vice versa. If the 50-day is below the 200, we're going to keep a bearish bias. But as you can see, this happens quite often that we get whipsaws when one moving average crosses above the other, but truly the trend, the bigger trend of the market did not change. So what I did is I created a market breadth index, MBI. And what it does is it attempts to eliminate those whipsaws and also help predict the kind of like a true changes in the long-term picture. What it is I took several of the market breadths, momentum, and trend indicators and rolled them sort of into one indicator and plotted it as an oscillator. So if the oscillator MBI is below the red line here, then we're going to keep a bearish bias until the indicator surges to above this blue line, and vice versa. If the indicator is above the blue line, we're going to keep a bullish bias until the indicator surges below, drops below the red line here. And as you can see, this is a pretty powerful indicator. It called 8 out of the 9 major trend changes in the past since 1970 here. Notice here there was one miss for this indicator. This bear market here in the 1980s, 1981, 83 was not called by this indicator. You can see that it did not drop below the red line, and then of course it was confirmed in the 1983 that the bull market began 82. So currently it's on a bearish picture here. You can see that we had a drop below the red line, and also we had a crossover, the bearish crossover. Now once again, the crossovers can whipsaw quite a bit, so that's one of the reasons why I developed this index, is to see if I could improve the bias determination, if this is a bull market or a bear market, and try to eliminate many of the whipsaws. So two of the bigger and kind of closer to home whipsaws were in 2010 and 2011, when the 50-day moved below the 200-day, but truly the trend did not change. We still continue to have a bull market. Now let me just zoom in kind of closer to today's date. So this is going back to 1995. You can see that market breadth index really was spot on in calling the major trend changes. And also here in 2010 and 2011, you can see that the moving averages did cross over, but truly the market breadth index did not drop below this red line. So a bear market was not called by this index. Now, currently we have a different picture. We do have this index did drop below the bearish threshold. So currently we are on a bearish mode. And this today's picture, I think, is significantly different than the ones in 2010 and 2011, as I showed. They were not called by this market breadth index, and I think that currently we have a much more bearish picture than we had before. So for all practical purposes, I'm going to say that we are in the beginning stages of a bear market, and I'm going to look for shorting opportunities within this bigger downtrend, the beginning of a bigger downtrend. All right, let's move on to some fixed income, and this is TLT, 20+ year Treasury bond fund. So a lot of volatility here. You can see this right here, a gap down and the continuation lower was during Mario Draghi's press conference. But you can see that pretty much that was it. That was the low. The bull stepped in and started pushing the prices higher. Here we had what I think this is a breakout. This is a breakout above this trend line. And also what was important is that when the interest rates announcement that the interest rates are going to go up was announced, truly there was not much of a reaction from the bonds. I think they kind of, they actually, especially this week, you can see that they really held support in this area here and then continued higher. This is more indicative of a flight to safety patterns versus the interest rates affecting the actual prices of bonds. So these are long-term bonds, and the investors are really trying to position themselves for some sort of a stock market correction, I think, versus worry about the Federal Reserve raising the interest rates. Another one from the bond universe, of course, is the municipal bonds, and again hit an all-time high here on Friday. You can see this was a very powerful move for the municipal bonds here since the mid-November. And again, this is very telling. Why would bonds hit all-time highs when the stock market is supposed to be in a bull market? So this again is another piece in the puzzle, and I think again that stock market is probably already in the beginning stages of a bear market, and the investors are positioning themselves for protection into bonds. All right, next let's look at the US dollar. So we had a breakout here in November and continued basically to 52-week highs. We came just shy of the 52-week highs. Then we had a Mario Draghi's announcement that they're going to ease less than the market expected. Somehow this was bullish for euro, and we had this pretty large red candlestick with a little rebound, but then I think we found support here, and then rebounded again today on Thursday and Friday. So looks like we're again going to attempt to challenge this 52-week highs, So this is a bullish chart. I don't normally trade the dollar itself, but I think, I actually mentioned this to my subscribers here around this area here. I said if I was trading dollar, I would be buying it right now. And lo and behold, we had a rebound. So again, this is a bullish chart. If the dollar continues to gain, it will weigh further in commodities if they need any more weighing upon. So next we'll go into a commodities part of the presentation. All right, this is a gold spot price daily chart. So we had a breakdown here in November below this July lows, and since then we kind of went sideways and attempted to go lower to multi-year lows, but then here this was a two-day reversal on the heels of Mario Draghi's speech. But you can see that it basically almost immediately failed here in 1088 area and then continued lower. As a matter of fact, here on Thursday, this was a multi-year closing low. This was a multi-year low here. So, there are possibly we're going to get a rebound to maybe this 50-day moving average, maybe even this 200-day moving average. But again, this is a very bearish security, so if we do see a sizable rebound, I think we will see short sellers step in again and attempt to push the prices lower to, again, multi-year lows. An alternative scenario, of course, is a breakdown to about $1,000. And let me show you how I estimate the breakdown. So we can go to inspect button here. And this could be like a cup and handle, maybe. This is a inverse cup and handle rather. So the way to estimate then, you go to the height of the pattern, and this is very aggressive estimate from the top of the pattern to the breakdown. So that's another $100. You can see on the left there, $104. And then if we break down from 1070, another $100 would actually put us below $1,000. A more conservative estimate is go from this height here, so that's about $70. So that would put us down to about 1,000. Next is a GDX Market Vectors Gold Miners ETF. This is a daily chart as well. So a similar picture to what we saw in gold, but I think GDX is even weaker than gold itself. Although you can argue with that because we see here at the $13 area, there is a lot of support here now, and we see quite a bit of attempts to break below the support, but so far all of them have failed. Now, will this attempt to break down below this $13 area succeed, or will it fail? Remains to be seen. Of course, if gold does break down, sufficiently further down, then GDX will surely follow it as well. Alternative scenario, of course, is a rebound to, well, maybe this 50-day moving average. Although you can see here, this is also Mario Draghi's speech here. You can see here that it failed around the 50-day moving average, and then pushed lower. Now, another possible way for it to rebound would be maybe to the 200-day moving average, and by the time it rebounds, probably will be around $16. So the way I see it, there are two options for it to go, and then one is to go to around $16, possibly fail there, and another, of course, is a breakdown below $13. Okay, next let's look at oil, West Texas Intermediate Light Crude Oil. This is a daily spot price. Again, very bearish. We hit multi-year lows here just a few days ago, and then this is a very interesting telling action. We have hit multi-year lows, rebounded, and then here this candlestick looks like a shooting star, came exactly to the broken support at 37 and change, $38, was rejected, and then we had a continuation lower, and just prices were not able to push higher at all. Now this could be like a rising wedge of some sort, and we saw what happened when we had the rising wedge here. Also a breakdown below support, a rising wedge, and then a wedge break here, and then a continuation lower again. So this could be a similar pattern. We had a multi-year low, and now possibly we're rebounding in a rising wedge pattern. Now, again, we can do a little quick estimate of where oil might be going, and we could do it, again, I guess we could do it conservatively. So a very conservative estimate, because we had a breakdown below this support. So let's measure the height of the pattern from here. This is a conservative estimate, so that's another $5 from the breakdown. And then we are about what, $3.79. So another another $2 would be somewhere around $32. Now a more aggressive estimate, I think, would be from the top of the pattern here, from about here, and that's around $12. Height of the pattern is about $12. So from here, from 37, another $12 down would be $25 or so. So it's entirely possible we'll get there. I don't exactly know how or when we'll get there, but by the way it looks, we might get there within a few months or so. And of course, an alternative scenario would be a rebound, possibly to the broken support again, or maybe to the 50-day moving average. But then again, this is a bearish security, a down slope in bearish security, so any sizable rebound most likely will be shorted. Staying with the oil topic for now, this is XES, S&P 500 Oil and Gas Equipment and Services ETF. So just eyeballing this chart, you can see it's very similar to the patterns we see in oil itself. We had a pretty strong plunge, an attempted rebound, another plunge, and then many commentators actually said that this was a double bottom and a breakout, because we had here three white soldiers, these three candlesticks. Now I questioned that rebound, and I see that we got basically at this point the shorts came in and started shorting again. Today, Friday rather, we had a breakdown below this support level with a close below both October and August lows. This is a multi-year lows as well. So if we're going to do a similar, because this is also like an inverse cup with handle, and again we can do a measured move based on the height of the pattern, and we can do it really quickly actually right now. So we can do maybe a conservative estimate from here. Let's say this is about another 10% or $1.88 down. So this would put it at about $16 or so. But I think we can also do a more aggressive estimate is from here to here. So that's another $4 down. So from 17 by about $13. Another 20% down. This would be in line with a projection of oil being in the mid to upper 20s sometime in the future. Of course, an alternative scenario is a rally, and maybe it will rally to the 50-day moving average, maybe even as high as $22. There's lots of resistance in this area now, so it could get shorted again here, around here. All right, next on the agenda is natural gas. This is spot daily price. So actually kind of similar to what I was just talking about in oil. Here in November I was pointing out this pattern here from this low, attempted breakdown but a rebound, kind of a counter trend rally. And I was saying that based on a measured move, if we break down, I was being very conservative. I was measuring it from here, so it was about 6%, and then another more aggressive estimate is from here to here. That's another 12% down. So following this breakdown here, this was a close below support right here on December 2nd. Close below support, we had a breakdown. Let me see how much it was. This is a 23% here breakdown. So I clearly underestimated how much of a breakdown this could be. And then again, once again, those measured move targets are really just that. They're targets and estimates. Now we had a gap here, a really big gap. So this gap really needs to be filled one way or the other. But so far, I wanted to point out a bunch of attempted failed rallies. So like all of this hammer candlestick here or here, possibly even today and Friday. If you're trying to pick bottom, you have to be very careful. And in fact, I would highly discourage people from attempting to pick bottoms in a bearish security, because exactly this is what happens. Excuse me. You can think that this is a bottom and then buy it right there and then wait a day or so and then it will collapse on you, gap down on you. So, I really try to, well, actually, I just don't. I just avoid picking bottoms in a bearish security. Bearish security, I always look for overbought conditions and try to short them. So, when would this overbought condition present itself? This gap really needs to be filled. So, a rally to at least here was possible, but of course a better shorting opportunities happen above the 50-day moving average. So I'll be looking for a bounce about the 50-day moving average to short again. And I wanted to show another security, FCG, which is a natural gas ETF, which contains stocks related to natural gas. So this is another kind of classic case of a failed rebound, and then this height of the pattern, following the breakdown, was duplicated on the downside. So this is exactly a measured move target. It was already hit. I don't know if it's going to continue lower. I just want to illustrate how this really sometimes works really quite well. Of course, breakdowns don't always work out. You can see here there was a close below support and an immediate rally back. And then here another close below support and an immediate rally back. So those breakdowns don't always work out. Okay. That's all I want to say about FCG. Okay, I also want to show you how to find us on the internet, so please go to MasterChartsTrading.com. We do have trade alert services which are live right now, and it's only $24.95 per month with a 3-week free trial. I think it's well worth the money, and you get timely alerts on when I go short or long, whatever various securities. So I think this is a great value, and my clients have been pretty happy about them so far. We also have a blog here where this information that you're watching will be posted. Also a video section, same thing, you will see the information there as well. If you go to public charts and social page, you will see that we have this link here, public charts page, and this link will open and show the charts that you saw in this video. If you sign up for our mailing list, you get a special discounted price for our trade alert services. If you have Twitter, Facebook, YouTube, or StockTwits accounts, please follow us there as well. That's it for this week's recap. Thanks for watching and have another great trading week. Bye-bye.